Today, we're going to be taking a look at another uranium stock. Today, probably one of the most popular stocks out there. Let's get right into it. Hey, my name is Tucker Kraus and welcome to my channel. In today's video, I'm going to be going over global atomic stock. So before we do that though, make sure to smash that like button. I will likely be comparing it to Fission here and there throughout the video since that's the only other uranium company I've done in-depth review on. And I plan to do a more in-depth review, so of course comment down below which other companies you would like to see. Let's get into it.
So to quickly touch on the stock itself, we have Global Atomic trading as GLATF on over-the-counter exchanges in the US and as GLO on the Toronto Stock Exchange. They are fairly small market cap wise, about 300 million, with no dividend obviously due to them being smaller. Price per pound wise though, they look quite cheap, only $1.22. So let's quickly hop over to some snippets I pulled from their presentation. Alright, so first slide I have here just goes over their capital structure, and this market cap has of course fallen a decent amount from 509 million down to about 380 as we can see here, but that's not too important. The main thing here, or well, there's two main things, but first up is that they do not have a ton of shares outstanding. I like that. I prefer when companies aren't diluting their shares a whole bunch, right? We can see 162 million. We can go back here, market cap 382 million, so significantly less shares outstanding compared to their market cap. And we can see over here that for the shareholder composition, that management and board holds a significant amount, about 25% of the company, which I really like. For me, I'd say 5 to 10% is acceptable, but 25% is absolutely excellent, especially compared to the last company I looked at, Fission Uranium, or only uranium company I've looked in depth at, which only had 0.5%, which was quite worrying. Next thing is just going over some of their timeline. The left side here we have their past, and so I'm not focusing too much on that. We can see on the right side here, though, what they're planning to do in the future. So first up, they're going to complete their feasibility study, and of course, right now they only have a pre-feasibility study, as well as from 2022 to 2024 actually be making or constructing the mine, So if we can actually see this mine up by 2024, that would actually be pretty impressive. Should be good timing to produce during the uranium bull market. And if, like down here I just have a little note, very fast timeline, which is pretty impressive considering, yeah, they've been going really fast here since like 2017, going through all these different permits and whatnot. Part of that I'm sure is from the jurisdiction, which I'll hop into a bit more in depth in just a moment. So, and here's just their expected production from phase 1, which is, I'm only going to be looking at their zinc plant and phase 1 of production in today's video, but you can see that they'll have significantly more coming from their later phases, as you can just see right here, with phase 2 being overlaid. And so, of course, yeah, this shows that likely we're going to be underpricing the company, but it's too far in the future, so we don't really have a choice, because yeah, even Global Atomic isn't really looking at phase 2 expectations quite yet, or feasibility studies for phase 2, I should say. And just from an interview I listened to with the CEO, I just wanted to note a couple interesting things, is that DASA will be Niger's premier mine since older ones have recently been shut down, which of course did allow them to get a whole bunch of the manpower and equipment, or is going to allow them. I'm not sure where they are in that timeline quite right at this second, but going to easily be able to get lots of this old equipment and that old workforce and not have to spend a whole bunch to get a bunch of new stuff and look around for new people to work. And he also thinks when the feasibility study comes out, the CEO, that the OPEX and CAPEX will decrease, which is, you know, that's always a good thing, and that if the uranium price demands it, they could 1.5 times to 2 times their output, which is insane. You'll see why when I get to the discounted free cash flow in just a second. Now, let's quickly look at an overview of their project. So we have the DASA deposit here with a substantial 250 million pounds of uranium, though of course note that we'll only be looking at phase 1, which will only be producing 44 million of those 250 million pounds. So of course, like I said earlier, we're substantially underpricing the company, if anything here. They do have a royalty of 9.14%, which is of course better than say if they were sharing the mine and only had 50% ownership in the mine itself, but that's likely because they took this royalty rather than, if we go back here, diluting all their shares, which honestly, I think I prefer. I'll take the royalty over the share dilution. They have a very high grade here, especially for something that's not in the Athabasca Basin with 0.54%. They also have a very low capex here with 276 million in total capex and 203 million in initial capex. Their OPEX is also $13.52. When we go to their construction, it's going to be very fast in only 2 years. At least that's kind of what I got from the presentation here. And so even phase 1 on its own is going to be producing for 12 years, not to mention all of the other phases that they'll go through, since of course there'll be a lot of pounds remaining in the ground. So that 2024 production may be optimistic, but if it's true, it'll allow production to happen during the bull market and not after, like a mine that might open in 2028 or so, like Fission's. And so that's of course going to be preferable. Though the mine is in Niger, which has some political stability risk, though it's a jurisdiction very supportive of uranium with ties to France, which of course is very pro-nuclear, has most of its power supplied from nuclear. Their zinc plant is in Turkey, which does have some currency risk, of course, since the Turkish lira has been rapidly falling in value, so that is something to keep in mind there. So now let's hop over into our discounted free cash flows, though I do have a couple different scenarios here. Alright, so before you click off, let me explain, because I'm sure you saw that number very quickly. So, I just want to go a bit more in depth into how I have this discounted free cash flow set up. It of course takes in the capex, opex, royalties, taxes, etc, etc. But it also assumes 50% capex inflation, right? So when you look here, oh, and opex, a 50% increase on both of these, so that of course makes them a lot less profitable, as well as a 10% discount rate compared to the usual 8%, which means those cash flows are worth less and their fair values are lower. So, I just want to note that was also applied to Fission. And so in this scenario, they are priced significantly higher than Fission at $55 per pound compared to about $49, I believe it was. And this only accounts for phase 1. This isn't even including their zinc plant at the moment. So keep that in mind. And at $60 uranium, it doesn't look like there's a ton of growth potential there. When you factor in their zinc plant, there is still a good bit more growth potential at $60, and they're actually priced very similar to Fission at this moment at the high 40s range. And of course, this for when I was valuing the zinc plant, just the cash flows that were coming from it, I assumed current zinc prices. I don't know enough about the zinc market. Maybe it's going to go up, maybe it's going to go down. I'm not sure. Keep that in mind. So, like I said earlier, when the CEO brought up that they could 1.5 times to 2 times their production if uranium price demanded it, I did want to do those scenarios as well. So we can see here, they 1.5 times their production. They're actually only trading at about $39 per pound and have 145% upside when you're looking at $60 per pound uranium, with even these conservative numbers of the 10% discount rate, 50% capex inflation. And of course, the CEO even said they think the capex and opex are going to go down, not up, like I have here. And so, of course, that then actually shows them beating out Fission in this scenario compared to the other two, where Fission beat them out significantly in the valuation. 2x, now it's just looking crazy. You have a triple here, and either way, there's still going to be over 150 million pounds on the ground if they double that 44 million. So, of course, still even more growth potential left on the table here. All in all, I think this 1.5 times, that's probably more realistic than a 2 times. The other thing I want to note, though, is just the overall kind of review. I would say I think I prefer the management here for Global Atomic to Fission, because that's, of course, the only other company I've looked at, like I said earlier, since they've actually, Global Atomic, their CEO's been out there doing lots of interviews and whatnot, and so that's always nice. And then, of course, there's the higher board ownership of the company, less share dilution, and, of course, all that extra amount in the ground. For Fission, it was their entire deposit, and they're coming online way later than Global Atomic, and they're using up their entire deposit, whereas when we're looking here, there's still a ton left for Global Atomic. Because that is so big and they have the zinc plant, it's very possible Global Atomic could become like a Chemical in the future, just because they have so many resources and have all this massive growth potential here. Though, either way, you still want to continue looking at more companies. Comment down below what I should look at. Of course, this is not financial advice, for entertainment purposes only. Thanks for watching, and I will see you next time.